It's human nature to overcomplicate things and miss the answer that's staring us in the face in the most simple of tasks. This applies to investment management as well. So I'll share 2 ways to approach investment management whilst keeping it simple and easy to understand. Welcome to another episode of Money Matters. There are 2 main ways in which you can approach investment management. The first is strategic allocation and the second is tactical allocation. Let's talk about strategic allocation first. You may also call this a buy and hold strategy. The positions you pick in the markets are many and also well diversified. As such, the performance of your portfolio is likely to largely follow that of market performance. You are likely to use collective investments to give you a well-diversified portfolio and exposure to every single market. For example, you might use an S&P index tracking ETF or perhaps a US global equity mutual fund to give you exposure to the US market. By using equities and accepting that your portfolio will largely follow market performance, you may expect returns of a high single-digit figure per annum. Nothing wrong with that whatsoever at all. Do bear in mind, however, a buy and hold strategy does not mean buy and forget. You still need to monitor and manage it on an ongoing basis. However, it is lower risk and the less time-consuming of the 2. It is also more suitable to the majority of investors. It is suitable for those who are not investment experts or don't have the time or are not inclined to give the time towards managing their portfolio. Let's talk about tactical allocation next. In contrast, this method means you are trying to outperform the market by taking tactical positions in specific companies or specific sectors. You are not building a well-diversified portfolio that aims to track the market. A tactical position might involve buying undervalued companies that you feel are currently priced at less than what you think they're worth. Therefore, you are betting against the market. You are going against the consensus. For example, this global pandemic has devalued companies significantly on the belief that earnings will be affected. That is true. However, you may feel that certain companies, whilst their earnings will be affected, if you're looking at the long term, you think that they are best positioned to weather these particular set of circumstances and that they'll bounce back quite strongly. So you're buying at a price that you think is undervalued with the expectation that it's going to bounce back in a certain amount of time. Other than picking value stocks, the other method of taking a tactical position is to buy growth stocks or maybe growth sectors. So you're deliberately picking certain sectors or stocks that you feel are going to do particularly well and are on a growth vector. And by doing this, you're excluding other companies or other sectors that you might think will deliver mediocre returns and only focusing your investments on the sectors that you think will do particularly well. So they might be growth sectors, for example, cloud computing has done particularly well. The growth of video gaming and esports has done particularly well. In the past, I've talked about the semiconductor space as well, doing quite well. So you might, instead of buying the whole market, which is what you're doing with a buy and hold strategy or a strategic allocation, you're taking a tactical position on certain sectors or stocks. Now, this obviously, the success of this method is based on you picking the right sectors or the right stocks. So by taking a more sniper approach to your investment selection, you're excluding other stocks or sectors that you think will provide only mediocre returns or even poor returns, and only focusing your money where the growth in the growth sectors or particular stocks or sectors that you feel are undervalued and therefore will generate you returns in the future. Now, this obviously assumes that you're going to pick the right investments. So therefore, tactical allocation is always more risky than strategic allocation. And also the other factor that comes into mind is that timing becomes more of an issue. It does require extra due diligence. It does require an extra level of skill for you to enter the market at the right time and also exit the market at the right time as well, because you're trying to buy into sectors or buy into certain positions at the right time in the market. Therefore, if an investor reverts to a buy and forget habit, he gets lazy, then actually a tactical allocation could lead to some very severe losses, in which case a strategic allocation is a much better decision. So tactical allocation certainly needs more skill, more time and more expertise to make it a success. Through tactical allocation, really the sky's the limit in terms of returns. So we're talking double-digit figures, potentially far and above strategic allocation, what tracking the markets may give you. But bear in mind is that is on the assumption that you make the right decisions. A lot of people don't make the right decisions, and in fact they actually incur severe losses. So to summarize, if you're not an expert or you can't afford the time to put in the due diligence and the proactive management of your portfolio, use strategic allocation. Nothing wrong with that whatsoever at all. You can achieve high single-digit figure returns on a yearly basis, and you know, as long as you enter the market as early as possible, you can benefit from some serious compound growth. Now, if high single-digit figures are not enough for whatever reason, and you're seeking double-digit returns, then sure, use tactical allocation. Put in the time, put in the research to select the right stocks, the right positions in the market, get your timing right, and enjoy some serious returns from the market. Okay, you have to go against market consensus, go against what other people are saying, and also take advantage of the fact that many of the market makers have a very short time horizon. They're thinking what's going to happen this week, this month. Whereas for most investors like ourselves, we actually have a far more medium to long term time horizon, and we can take advantage of that. Like I said, with the pandemic, many companies, their prices plummeted 20-30%. We can use that to our advantage and buy in at that market low point. But we have to go against, obviously, what we're doing there is going against the market consensus. So you need to also put in the time to proactively manage as well. Certainly with tactical allocation, you cannot buy and forget. You have to invest your time to proactively monitor the markets and manage your investment. But whichever route you take, I think many people would and should use wealth advisors to manage their portfolio for them. There is a certain value in hiring someone. You spend a bit more money, but you hire someone to do that building of your portfolio and the management of that portfolio on your behalf. And there's a video, I think, on the channel somewhere talking about the difference between DIY, do it yourself, or hiring a professional to manage your portfolio for you. Whichever method you pick, strategic, tactical, I wish you many years of happy returns. Don't be afraid to invest. Invest as early as possible. Invest your time to managing it, and you'll come out at the other end far better off than when you entered. So I wish you many, many good returns. Thank you for joining me on this episode. Put your comments below. Ask me a question about your portfolio. Let me know what other videos you want to see on the video. Smash the like button, subscribe, and I'll see you on the next episode of Money Matters.